I'm very confident we are in a bull market in gold, which started in February. If silver gets above $200, I can see myself selling my silver and converting it into gold. But silver, I think it could go all the way back down to $50 is a possibility. Probably won't, but that's in play if they don't fix this war in Iran. Wall Street finally might wake up to the fact that the Strait of Hormuz could create a recession in the U.S. And if they wake up to that fact, you're going to get a massive sell-off. And I call this the pushing the panic button. If that happens, then gold will retest 4,100, easily to retest 42, which is the 200-day moving average. If that doesn't hold, you're going to go sub 4,000. These floors, 3,500 to 4,100 for gold. So whatever gold does, that's what silver will do. Silver will follow. And so right now, I'm negative on silver and gold in the near term. This is the reason why Warren Buffett has hated gold most of his career, because the U.S. economy has been the dominant economy for his entire career. So I don't need no stinking gold. I got the U.S. economy. I'll lean on that, right? I'm very confident we are in a bull market in gold, which started in February of 24. In February 24, gold was at $2,050. And less than 2 years later, it was at $5,600. So it rose $1,800 in back-to-back years. So it went from 2,000 and it almost doubled and doubled again. So gold has been ripping, and the reason why gold has been ripping, the irony of ironies, is that simultaneous to that, the S&P 500 has been rising. That's not supposed to happen. Who's telling the truth here? Because today's a good example. So the S&P ripped higher 2%, and gold basically in the East was up more than 2%. But then once the West started opening their markets, New York sold gold off and said, we don't need no stinking gold. And gold went all the way back to flat. And so that's that war, that who wins? Gold, the stocks are gold. From Wall Street's perspective, they're like, apples and oranges. And I don't want to own no stinking gold. I want to own stocks, right? Why is gold going up, right? Well, the rest of the world's buying gold. Why? Because they're nervous about our bond market, which we're not nervous about. It's all about the bond market.
Markets are sending two completely opposite signals, and most investors are choosing the one they want to believe. As Don Durrett points out here, gold doubling while the S&P 500 climbs isn't confirmation, it's a contradiction. When both risk assets and safe havens rise together, it usually signals hidden stress, not strength, especially with global buyers accumulating gold while US markets dismiss it. The April session he describes shows clear regional divergence, east buying, west selling, which often precedes volatility shifts. If bond market fears are driving gold, ignoring them could be the real risk. Next, Don Durrett unravels what's really breaking beneath the surface.
The reason why gold is in a bull market is because the bond market, what I explained to you. If Japan decides to sell their bonds, it's game over. So people are starting to realize this, that, wait a minute here, does the U.S. have a debt problem? I think they do. Let's buy some gold. So now, I think we're going lower in gold and silver. So you said, are we strong or weak? Today, we're at $74. It was at 77 on the open, up about $2 on the day, I think. And but silver, I think it could go all the way back down to $50 is a possibility. It probably won't, but that's in play if they don't fix this war in Iran. Now silver's going to follow gold. So you don't even have to focus on silver's chart, silver's fundamentals, any of that stuff. The only reason why I say 50 is in play here is because of gold. Now, the only way that's going to happen is if gold goes all the way to 3,500, which probably won't happen. So the recent correction went down to 4,100. I think 4,100 holds. If 4,100 holds, then silver will probably go to 62, 63. So my expectation, and this isn't that far away, I'm talking, a week from now, April, mid-April, late April, if this war doesn't end, the key's the war, right? If the war doesn't end, Wall Street right now is at 6,800. If this thing could turn around and go back to 6,350 in a heartbeat, and then go lower, 6,000. So the stock market really didn't really sell off on this Iranian war yet. It hasn't. So, and the Iran war isn't over yet. That's still kind of in play. So if the Iranian war doesn't get resolved, the key here is, what is Iran going to do? Iran can create headaches for the entire world. And if they do, Wall Street finally might wake up to the fact that the Strait of Hormuz could create a recession in the U.S. And if they wake up to that fact, you're going to get a massive sell-off. And I call this the panic, pushing the panic button.
The real risk isn't gold falling, it's the bond market breaking while equities pretend everything is fine. As Don Durrett points out here, the idea that Japan could trigger a sell-off exposes how fragile global liquidity really is. Silver at $74 flirting with a potential drop to $50 isn't about metals, it's about systemic stress and geopolitical escalation into late April. Meanwhile, equities near 6,800 haven't priced in any serious Iran risk, which creates a dangerous disconnect between headlines and positioning. If markets suddenly reprice recession odds, that panic button could hit fast. Next, Don Durrett discusses what that panic actually looks like when it begins.
Wall Street has not pushed the panic button. The panic button doesn't occur until you're kind of at the end of a cycle, and we haven't seen it yet. And you know when people push the panic button, that's when people are like, "I'm out. I'm not going back. I'm out. See you later. Have fun," kind of thing. We haven't seen that yet, but I think we're getting there, and I think so if that happens, if we see the panic button get pushed, then gold will retest 4,100, easily to retest 42, retest 4,100, which is the 200-day moving average. If that doesn't hold, you're going to go sub 4,000. And if you go sub 4,000, then you don't know what the whoosh is going to be. The whoosh is that extra sell-off that nobody expects. That's the whoosh. It's like whoosh, whoosh, the whoosh down. You're not expecting, right? Nobody's expecting that.
True market panic doesn't start with fear. It starts when confidence quietly disappears. As Don Durrett points out here, we haven't seen that final capitulation phase where investors fully disengage, which usually marks the real bottom. The 200-day moving average near $4,100 becomes critical because historically, once that breaks late in a cycle, downside accelerates quickly. What he calls the who move is essentially forced liquidation, something that tends to catch over-leveraged positions completely off guard. For investors, that's where portfolio risk isn't gradual, it's sudden. Next, Don Durrett shows how these unexpected drops punish the most confident players.
So these are the people that the options players that, that they basically sell these puts that are way, way down there. Oh, gold will never get to 3,800. So they put $1 million put in there, right? And then they get the whoosh down, and then they get eaten alive. So the whoosh down is in play here. And so these floors, 3,500 to 4,100 for gold. So whatever gold does, that's what silver will do. Silver will follow. And so right now I'm negative on silver and gold in the near term, but I think by June I'll be bullish. I think we'll be trending up back higher again, and it'll be interesting because the driver for gold and the driver for the S&P 500 are not the same thing.
Yeah.
People need to realize this. They're both at all-time highs, right? Well, gold isn't anymore. It was in January. But the drivers are not the same thing. And you really need to understand that. And that's one of the things that people don't understand, because they look up and gold and silver are both at all-time high. Gold and the S&P are both, they think they're the same drivers. Gold has been acting like a high-risk stock. That's what it's been acting like. But it's not a high-risk stock. It's actually the opposite of that. It's the opposite, which is ironic. So gold and silver are difficult to understand, and that's why most people don't touch them. I always say the only reason to own gold, the only reason to own gold miners is if you're pessimistic about the U.S. economy and pessimistic about the U.S. bond market. Those are the reasons you own it. In other words, you're a contrarian to this so-called, U.S. dominance mentality. If you're pro-U.S. economy and you don't have any worries about the debt, you shouldn't be owning gold. Because if you're right, gold should do nothing, right?
The biggest losses rarely come from being wrong. They come from being overconfident at the extremes. As Don Durrett points out here, those selling deep out of the money puts are essentially betting that volatility is dead right before it spikes. The $3,500 to $4,100 range isn't just technical, it's where leverage either survives or gets wiped out, especially if that woo move materializes. What's often ignored is that gold behaving like a risk asset recently is a liquidity signal, not a fundamental shift. When investors misread that, they position incorrectly. Next, Don Durrett unravels why most people misunderstand gold's true role in portfolios.
This is the reason why Warren Buffett has hated gold most of his career, because the U.S. economy has been the dominant economy for his entire career. So I don't need no stinking gold. I got the U.S. economy. I'll lean on that, right? And so, but we're entering an era, a new era where, the U.S. dominance just went bye-bye. So what's going to happen here soon? I wrote about this in my January newsletter. I said, this is the last year of American greatness. So in other words, this is really the last year that the Buffett model works. And the Buffett model is you can ignore gold and you can just buy S&P 500, just buy you can buy the ETFs and everything's fine, everything's rosy. That ends this year.
What single variable, if wrong, would invalidate your entire thesis on gold, silver, and mining stocks?
The only thing that would invalidate it would, at this point, I'm more like a 99.9%er expectation.
The biggest shift isn't gold rising, it's the potential end of a decades-long playbook investors trusted blindly. As Don Durrett points out here, the Buffett model worked because US dominance, low rates, and stable growth all aligned. But that environment may be breaking in 2026. If capital starts rotating away from US equities despite strong index levels, that signals structural change, not a temporary cycle. The claim that this is the last year of that model sounds extreme, but even small cracks in earnings quality or debt sustainability could validate it. Investors need to question what assumptions they're still carrying. Next, Don Durrett discusses what could actually invalidate this entire thesis.
But there are a few things we can talk about. The first one is the U.S. economy basically not going into a recession. So if it doesn't go into a recession and the U.S. is able to kick the can, say, for another 2 years without a recession, it's possible that gold could go down or stay flat. And that would be very, very disappointing for me as a gold silver mining stock investor. Now, gold and silver would do fine. They would just be flat. They wouldn't go up. They might go down a little bit, but they wouldn't perform very well. So the U.S. economy, that's probably the biggest risk. The second risk is basically a new energy technology device comes on the market, new technology that makes, it wouldn't be free energy, but it would be a device that would be like low cost energy, which would basically overnight kind of give a shot in the arm to the global economy. That happens, like I don't need any gold. We're doing great here. We got this new energy device, right? So those two, I think, could put a damper on gold, could put a damper on my expectation that gold's going to trend to $7,000. But I think both of those are very, very tiny probabilities. I do think we will have these new energy devices. I just don't think they're going to happen in enough time. I see them more like 28, 29, 30. They're down the road. I don't see one happening this year. So 26 and 27 is really when the rubber's going to hit the road as far as the recession goes. So can we avoid a recession? Can we have a new, some type of an energy device? There's a third one. The third one that it could bite us is some type of a reset. So, and I don't think they would do a reset unless they had a crisis. So in order to prevent gold from going higher, you'd have to basically come in and say, okay, we're gonna create a stable coin that's based on assets, gold, silver, Bitcoin, US treasuries, and maybe some currencies.
The real threat to the gold thesis isn't collapse, it's stability lasting longer than expected. As Don Durrett points out here, if the US avoids recession through 2026 to 2027, gold could stagnate despite all the macro fears, which is a frustrating but realistic outcome. Markets don't reward narratives, they reward timing, and delayed downturns can drain momentum from defensive assets. The second risk, a breakthrough in low-cost energy, would reshape productivity and inflation dynamics almost overnight, something most portfolios aren't positioned for. These aren't likely scenarios, but they expose how dependent the thesis is on macro deterioration. Next, Don Durrett unravels the third scenario that could disrupt everything.
Maybe we'll throw some Swiss francs and yuan, we'll throw those in there. Let's say we throw in like 10 assets and we create this stable coin and we back it by these 10 assets and then we peg it to inflation, not to the US dollar. We peg it to global inflation. If they did something like that, then why do I need gold? It's like, whoa, we can use this thing for international trade. We can do it for transactions. We just created a new global currency that's stable. Well, I don't need no stinking gold. So that would be the third possibility. And I don't think they would. Now, the one thing that's interesting about this third one, which is the most likely of the outcome, the thing that's fascinating about this is Mark Zuckerberg came up with this idea called the Libra coin. And nobody's copied him. He came up with this idea a long time ago. And as soon as he came up with it, the U.S. government said, hey, Mark, come on down to Washington. We want to talk to you. Sit down here in front of our committee. Hey, Mark, no Libra coin. You got it? No Libra coin. If you do the Libra coin, we're going to shut down Meta. You understand? Mark is like, okay, I hear you. It was a one-day deal. Libra coin was dead.
The system won't compete with gold. It will try to replace the need for it entirely. As Don Durrett points out here, a multi-asset, inflation-pegged global currency would neutralize gold's role as a hedge by offering stability with usability. This isn't just theory. Central banks and institutions have been exploring similar frameworks, especially post-2020 when currency trust started eroding. The shutdown of Libra shows how quickly innovation gets blocked when it threatens monetary control. So the question isn't whether this idea exists, it's whether it gets allowed during a crisis. Investors should watch policy signals closely. Next, Don Durrett discusses how to actually protect capital if none of this plays out cleanly.
A couple of billion-dollar question, how to preserve a capital in this environment?
Well, I think you got to own physical gold and silver. I think that those are the two assets that are going to hold their value. And so you got to own them. I think in minimum 5%. I think maximum 20%. So 5 to 20%, but it's basically your comfort level, your comfort level, but you got to go 5%. I always tell people, if you don't have 1,000 ounces of silver, start stacking it on a monthly basis until you get to 1,000 ounces. And then once you get to 1,000 ounces, decide if it's enough. Okay, I got my 1,000 ounces. Is that enough? So I think silver's going to go to, we're at 120. We're all at 120 already. So it's 1,000 ounces. So you're basically $100,000. And if it goes to 150, you're $150,000. So that's a pretty good safety net, if you will. That's basically going to get you through a few years if you absolutely need it. So it's just a safety net. It's your savings account, if you will.
What sounds like a simple allocation strategy is actually a bet on systemic fragility. As Don Durrett points out here, recommending 5% to 20% in physical metals isn't just diversification. It reflects declining confidence in traditional financial assets. The idea of stacking 1,000 ounces of silver, now roughly $100,000 at current levels, highlights how quickly the entry point has shifted for new investors. But here's what's not said. Liquidity, storage, and volatility risks increase as positions grow. This isn't a passive hedge. It's an active decision against the system. Next, Don Durrett shows why silver might outperform, but also why that comes with trade-offs.
But I've been saying this for a long time when silver was cheap. Now it's starting to get more expensive to get those 1,000 ounces. And then depending on which metal you like, do you like silver? You like gold? Do you want to do a little bit of both? I personally like silver because I think silver will outperform gold. I always say it would outperform gold by at least 2.5 to 1. So I'm getting 2.5 to 1 on my money. Why should I buy gold? Never made any sense to me. But once silver gets, they becomes very, the valuations get normalized, which I still think silver's going to outperform gold by at least 2 to 1 from here. So we're still early in that. But once they get normalized, I think at that point, gold probably makes more sense for a number of reasons. One, gold is not as volatile as silver. If you have shortages in silver, who knows what the government's going to do? I mean, there's so much uncertainty around silver, and you don't, as a store of value asset, you don't really want that volatility.
Outperformance sounds attractive, until volatility starts erasing gains faster than you can react. As Don Durrett points out here, silver's projected 2.5 to 1 upside versus gold is what draws investors in, but that leverage cuts both ways during corrections. Historically, silver has been far more volatile, often swinging 30 to 40% in short periods, which makes timing critical rather than optional. The idea of switching to gold after normalization assumes investors will act rationally at peaks, which rarely happens. This is less about choosing metals and more about managing behavioral risk under pressure. Next, Don Durrett discusses when and why that rotation into gold actually makes sense.
So I could see myself, if silver gets above $200, I could see myself selling my silver and converting it into gold. Then one of the best benefits of that is the weight. It's a lot easier to store gold than silver. So those are the two main assets. But there's other ways to protect yourself. One is, I forget who it was. I think it was Jeffrey Gunlock. He said, don't own any U.S. stocks. Own foreign stocks. You can do U.S. short bonds, but don't own any U.S. stocks, foreign stocks. I think that was good. I don't like bonds at all. I don't like short-term bonds. I don't like long-term bonds. And so international stocks, I probably will own some of those. And then, I like crypto. I like Bitcoin and Ethereum. I think those are going to do well over the next 5 years. I don't have any problems with both of those. And then probably some foreign currencies. I like the Swiss franc. And so I think those are kind of those are where I would run for safety.
Diversification here isn't strategy. It's a signal of declining trust in any single system. As Don Durrett points out here, the idea of rotating silver into gold above $200 highlights how quickly investors shift from growth to preservation once volatility peaks. Moving into foreign stocks, crypto, and currencies like the Swiss franc reflects a broader trend seen since 2022, capital quietly hedging against US-centric risk. But spreading across assets doesn't eliminate risk. It redistributes it across different regimes and policy environments. For investors, this means understanding correlations, not just owning alternatives.